This is Fintech Takes, the podcast keeping you in the loop on all the latest fintech trends, news, and ideas. I'm Alex Johnson, creator of the Fintech Takes newsletter, your host and self-confessed fintech nerd. Let's go. Hello, and welcome back to the Fintech Takes podcast. My name is Alex Johnson. I am the creator of Fintech Takes, and today I have a very special guest episode. My guest today is Rob Blackwell. Rob was a longtime reporter and editor at American Banker for about 20 years, as a matter of fact, with a focus on bank regulation and public policy. And for the last 5 years, Rob has been the chief content officer and head of external affairs for Intrafi. And in that capacity, one of the things that Rob does is host a wonderful podcast, Banking with Interest, which I have had the distinct pleasure of being on a couple of times. And I will tell you all, if you're not listening to it already, you absolutely should. It is my go-to podcast for all things bank regulation and banking law. It's exceptional. And Rob, I feel bad. I've been on your podcast twice, and this is the first time that you are coming on the Fintech Takes podcast. It will not be the last, but allow me to try to repair the damage I've done to our relationship. Thank you for coming on.
Well, I'm very pleased to be here. Long-time listener, first-time caller. Happy to be here. Thanks, Alex, so much.
Well, I am so glad to have you. I was thinking about what at the sort of midway point of February would make for a good topic or a good focus for a guest episode. And I have found myself, Rob, pretty much just constantly plugged into Twitter, unfortunately, trying to keep track of everything that has been happening in your neck of the woods. I believe you're based right outside of Washington, D.C. And
I can see the Washington Monument right from where I am right now. So
really? Okay. So like
it's as close as you get without being there.
I love that. So just first question right off the bat, can you see the Department of Government Efficiency like moving from building to building? Like, is that something you can witness?
It's like a SEAL SWAT team kind of thing. They pull up in a truck and then they offload and then they rush in. Yeah, I definitely can see them going across each and every agency, particularly with a focus on CFPB and somewhat strangely to me, the FDIC.
Yes, no, both of those organizations. And you actually, that's a perfect segue to what I wanted to talk about. My hope was to just do a little review of the four-letter agencies or three-letter agencies, because we talk a lot about the CFPB, the OCC, the FDIC, the Fed. We don't talk quite so much about the credit unions. Unfortunately, that's just another thing for them to get mad about, I suppose. But I try to talk a lot about what's going on from a regulatory perspective. And as we were just joking about, a lot has happened. So much, in fact, that this podcast might be tragically out of date by the time it runs. But we're going to recap what we know so far. And Rob, I want to get your take on just what you've seen, what you've heard, some of your observations. One of the things you do better than anyone is you actually get to talk to the folks who work in your neck of the woods in policy, up on the Hill. And so I think you have a really good sense of who some of the players are and what things might be sort of moving and shaking right now. So Rob, if that sounds like a good plan, can we start with the CFPB?
Yeah, let's definitely start there. I think it's a good place to start.
Okay, so again, things are happening on an hour-by-hour basis, so it's entirely possible that this will be a little out of date. But let me just quickly give a broad summary of what's been happening. I'm not going to recount all the craziness, but in broad strokes, I think there's three big things. First one is that Russell Vought, newly confirmed director of the OMB, has also been sort of placed as the acting director of the CFPB, replacing Rohit Chopra, who was fired. And Vought is aggressively moving to what I would sort of describe as grind the gears of the CFPB to a halt. So
shut the lights off. Shut the lights off.
Yeah, literally shut the lights off. Because
as many lights as he can. Yeah.
Right. He's getting to all the light switches and he's shutting them off. He closed the DC headquarters for the CFPB, which was interesting actually because the weekend before he did that, I actually was walking by the CFPB headquarters because I was in DC and there were a couple of protesters outside. I was like, this is kind of strange. And then all of this stuff happened like over the next 48 hours. So he closed the headquarters building itself. He basically instructed all of the staff to stop pretty much all of their work, including active litigation, enforcement, supervisory work. So pretty much everything that the CFPB was doing, he has been attempting to lay off a very large portion of the staff. That has run into some legal challenges that are currently being worked through. And he has also said that he is going to refuse to take any additional funding for the CFPB, saying that the amount that they already have is plenty, which, given the direction he seems to be pushing the Bureau, is probably true. That's probably more money than they need. So that is thing number one. Thing number two is that, as we were joking about before, representatives of the Department of Government Efficiency, who it sounds like are not legally allowed to rent cars at this stage in their lives, are visiting the CFPB. It's a little unclear to me exactly what they've been doing, which is on its own concerning, given that the Department of Government Efficiency isn't a real government department. But they likely at least have something to do with the fact that the CFPB's website, at least the homepage of the website, has been returning a 404 page not found error for the last week and a half, and reportedly have been making some changes to, I guess, sort of the technology side of the CFPB, including, it sounds like reportedly, maybe not having anyone actively monitor the portal for consumer complaints, which is a little concerning. And then number three, the third strand of our story here, is that Jonathan McKernan, formerly a board member of the FDIC, which he has since stepped down from, has been nominated to be the new director of the CFPB. And so he's not in that role yet, but he has been nominated to fill that role on a permanent basis. Okay, Rob, with all of that said, we were joking about this before we started recording, but my question for you, my core question around all of this is, what the hell is going on?
It's so tempting to answer the question with pass. Just pass.
Yeah.
I think what you're watching is a dynamic play out in real time, and probably it's helpful to think of it as two factions within Trump world. One faction, supported by many in the Republican Party, just generally, it's not unique to Trump, wants to shut down the CFPB. They never really liked it. They think of it as an unaccountable agency with an unaccountable director. They don't like the way the funding process worked, even though it's now been upheld by the Supreme Court, including by Clarence Thomas himself. So the conservatives were pretty unambiguously supportive in that front. So it's technically there to stay in terms of law. However, there is a large faction that thinks, okay, we get in, we take it over. That's what Vought has been doing, and we turn off as many lights as we can, and we do things like we stop all activity. Now, stopping activity. It's funny, when they first did this, when it was Treasury Secretary Scott Bessent who initially was named acting CFPB director because the OMB director hadn't been confirmed yet, right? And he was the one who initially put in the stop order. That's not that unusual when you have a transition between administrations, particularly when you have, it flipping parties. One party will come in and be like, look, we just want to look at everything you're doing before you do it. We don't want you putting out more enforcement actions until we have get a chance to look around it. So it's not that weird. What is unusual in terms of DOGE is they've taken steps to hire, I think it's like 150 probationary employees. So you technically in the government often have about 2-year period when you're technically on probation before they hire you. And it's a lot easier to fire you. It's actually harder. It is hard to fire people from the government. You have to go through either you're doing something egregious in terms of your behavior and it's got to be documented and all that stuff, or they have reductions in force. It's an RFI. I forget what the RFI stands for, but that takes like a longer process. But the probationary period is a sort of unique vantage point, and you're watching that play out at the CFPB and the FDIC, where it's much easier for them to say, okay, we're letting these people go. So there are probationary employees at the CFPB that they've said, okay, now we're letting go. And this is, again, part of that faction that wants to just dial back the CFPB as much as possible. And that is something that Russ Vought has been very open about in the past. I was hearing back in November and December after it was clear that, when it was clear that Trump had won the election, people in Trump land were telling me this is exactly how it's going to play out. So I can't say I'm shocked by the way it's played out. But what's interesting to note is there is another faction within Trump land and the Republican Party more generally that wants will want to use the CFPB to pursue their priorities. The CFPB is a very unusual agency in that it was always pretty political because one side wanted it and the other side didn't. Democrats were able to make it whole and create it in Dodd-Frank Act. And the first confirmed director was Richard Cordray, who the industry saw as political. Then he had Mick Mulvaney come in under the Trump administration, and he was very political and seen as very partisan by the Democrats. But then you had it sort of revert to the Kathy Kraninger, who I would view as a fairly, bureaucratic approach to the CFPB. She was not trying to burn it down. I don't even think
that's what I'd always heard.
Trying to burn it, right?
Yeah.
Now, but then you had Rohit Chopra, very aggressive CFPB director, seen by the industry and most everyone else, if you're doing a fair analysis, is pretty partisan. I mean, he was, the junk fee stuff that he was going on about. So it was seen as even more of a political agency. And the question becomes, do you try and shut down the agency and leave it shut down as much as you can, or do you just try and flip it on its head and do what you can with it? And I guess it's a long way of getting to Jonathan McKernan as CFPB director. He's probably going to turn some of those lights back on, not rehire the probationary employees. They're gone. But some of those, basically going to redirect it in a way that Republicans want to see that agency act. I doubt very much you're going to put a permanent CFPB director on there to literally do nothing. I mean, but you could. Like I said, you're watching two factions sort of vie out in real time. One time wants to shut it down as much as possible. The other will want to use it to pursue whatever their priorities are. And you're just going to watch a sort of back and forth on that.
Yeah, I think that's a really perfect way of describing it, because McKernan's nomination to be the permanent director of the CFPB, that was the part that was like, wait a minute, what are we doing here? It felt very out of left field relative to what Vought and Doge were doing, right? And so that was the part that I was sort of struggling with, but I think characterizing it as multiple different fractions within Trump world is a good way to describe it, because there are certainly lots of folks who I think feel that the CFPB in some form should exist. So the more sort of nuanced, I guess, critique of the CFPB is not that it's unconstitutional, not that it's, sort of a shadow agency doing all the work at the behest of Elizabeth Warren, which is kind of how you just hear it described in sort of conspiratorial terms. It's much closer to, we think something like this should exist, but the way that Rohit Chopra was running it was way too far out of bounds. And again, to be fair to your earlier point about like legitimate criticism, there was a lot of very novel approaches to like unfair and deceptive acts and practices. Under the Chopra era CFPB, where you could imagine a more sort of traditional approach to consumer protection would still be potentially very vigilant. And to your point about Kraninger, that's actually what existed under her. That CFPB took a lot of enforcement actions. It just sort of stayed within the regulatory perimeter that had already been defined. It wasn't trying to find novel ways to expand that regulatory perimeter. So I think all of that is fair. And it ties to something, Rob, that I wanted to ask you about, which is, there actually has been some reporting, and I've heard some burblings about this, I'm sure you probably have too, that we just want to shut the CFPB down entirely wing of Trump world that's kind of got its hands on the levers and dials and knobs right now, that actually is fairly concerning to even like banks and credit unions that, again, did not love the Chopra era CFPB, had lots of concerns with even things like capping overdraft fees or capping or eliminating credit card late fees, like some very sort of, very strong objections to what the CFPB was doing. But at the same time, I think probably view the CFPB as a thing that should exist in some form or function. And a lot of these consumer protection jobs used to be handled by the prudential regulators, a little bit by the FTC. So you could envision a world where it just gets sort of diffused across those organizations as well. But also that like the thing that's different today than was true 15 years ago is we have a lot more novel competition in financial services than we used to, right? It's not just banks and credit unions stealing market share from each other. It's a lot of startups from crypto, from fintech, from other places that are coming in. And I would guess that one of the concerns that banks and credit unions have is there's a bit of a consumer protection arbitrage that you can do if you're a new startup and you don't really care about those things and you just want to gain market share. And, banks and credit unions are never going to go too far in terms of those things because they're still going to comply with consumer protection laws. They understand it. So there actually is sort of, I think, an argument on the part of incumbents that the CFPB in some form or fashion still needs to exist. So my question to you is, do you get that sense from banks and credit unions? And if so, who in the industry do you think is like kind of pushing for or benefits from the CFPB just having all the lights shut off?
Well, the easiest answer for who benefits the most is to say big banks. And that was something that came up in hearings last week with Fed Chairman Jerome Powell, right? They were asked him, who's regulating the biggest banks for consumer compliance if the CFPB isn't? And the answer, according to Jay Powell, was no one. Now, the industry, I had Greg Baer, who's the head of the Bank Policy Institute, which represents the biggest banks, on the show recently, about a couple of weeks ago. Yeah. And his answer would be different. His answer would be like, look, the Fed never gave up power. They were supposed to. That was the deal we made, and back in Dodd-Frank, you have this other agency. They're going to do consumer compliance, and the Fed and the OCC and the FDIC aren't. Most of the big banks would tell you that they feel like they are. But technically speaking, they're not, right? Technically speaking, what Jay Powell was saying is correct. So who benefits the most in the short term? You'd say the big banks benefit. You'd also say big tech benefits because the only player in the FDIC and the OCC and the Fed have very, very limited power, pretty much no power over any big tech company that's playing in the financial services space. I'm thinking PayPal or somebody like that. Whereas the CFPB does, and it has unambiguous power. Back to a sort of earlier point of like, the important thing to think about is it's easy to say now, let's turn off as many lights on the CFPB as you can. And you can do that, but keep in mind what you're passing up as a Republican administration or any administration. The CFPB has enormous amounts of power and they're a tool that can be used. So I've never really believed the idea that you can shut down the CFPB for 4 years because ultimately someone in an administration, doesn't matter what they are going to look at that agency and be like, I can use them to pursue my goals. The Trump-Vance administration is a populist administration. You're telling me that they're going to look at that and think over a 4-year period, well, I could be using the CFPB to go after X or Y, credit card interest rates, whatever it is, but I'm not doing that because I didn't like the agency. It's a tool that you're voluntarily not using. It's very, very hard to resist. So I think once you have a permanent CFPB director in there, that's why I'm saying, like, I think those lights will come back on. The other thing to keep in mind is, especially for the big banks, I don't think the big banks are going to suddenly be like, yeah, I get a 4-year pass at consumer compliance now. Everything's great. And I'll tell you why. Because let's assume the Democrats come back into power in 2028. And it's a bit early to start talking about the election, but just assume for a moment they do. The laws did not change. The Republicans have not repealed any consumer protection law. And there are statute of limitations, but they go back further than 4 years. So if you are a big bank of Blackwell X, and I start being like, yeah, this is great. I can rip off consumers left and right, and there's no one to stop me. For starters, that's not true. You've got individual state attorneys general who absolutely can and will come after you. So that's not true. You can have Department of Justice come after you if you wanted to. But even if they don't, a CFPB under a future administration could absolutely look back at your behavior and come after you. So it's not like a free-for-all Wild West, bang, 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 everybody's shooting off their guns and they can do whatever they want now because, all these people at the big banks are really smart and they know even if they get a pass now, that pass is temporary at best and nobody's going to think to themselves, well, now I'm free to rip off consumers because, again, there are other players that can come after you, including states and blue states or even red states if they decide you're doing something bad and they want to be populist about it. So the way I think about it is, so someone's temporarily keeping the lights off the CFPB, and that may give technically an advantage to big banks and tech companies in the short term. But in the long run, that advantage is very limited and has a limited window.
Yeah, no, I think that's very well said and exactly right. I've heard the sort of there are no rules for the next 4 years sort of mental model be described as like Rumspringa, right? Where it's like, hey, go sow all your wild oats and you have like a limited period of time to just sort of go crazy and do whatever you want. But you're right. I mean, Well, yeah, because especially for these big banks where it's like, look, like, your institution is 150 years old. You're a systemically important financial institution. You're certainly going to be around 4 years from now and have shareholders you have to answer to. And you can't be like, yeah, the reason we're paying this $2 billion fine is because we decided to just not follow consumer protection laws for 4 years. Like, that's just not the way that big banks operate.
And you really think the New York Department of Financial Institutions is going to give you a pass? You know what I mean? Like,
I've met the folks who work there. No, they won't. Like they
and like no one at JP Morgan thinks that they will. So it's not like JP Morgan will say Jamie Dimon's like, well, screw this. Now I don't have to do X. They're never going to think that way. They're always thinking in terms of regulatory risk. So if it's not the CFPB, they're going to assume it's somebody else, or they're going to assume it'll be the CFPB later. So it's not a get out of jail free card, and to the extent that anybody's getting a benefit, it's not going to last that long.
No, I think that's right. The one group I would flag that seem very happy about the side of like the wing that you're characterizing is sort of turning off the lights on. In my head, I just keep seeing the Elon Musk tweet with the gravestone next to CFPB. Like
that actually deleted the initial
CFPB
tweet, right?
Yeah,
he came out he was like, he's a CFPB RIP, and I immediately retweeted it with.
I saw that.
And then he deleted it, and I was like, "Okay, what's going on?"
Oh,
and then he just added CFPB RIP gravestone emoji. But in between, I had a reporter like, "What did Elon tweet?" So someone was instantly coming in there, and I actually knew like this is the signal for Russ Vought, and this is part of the DOGE plan, Doge plan to like turn off lights. I'd be surprised. There'd be a lot of self-restraint if they kept the lights off for 4 years because, again, this is an agency you can use to pursue your own goals. You're really going to sit there and not use it? Seems unlikely.
The irony of the whole situation is that Chopra's kind of a populist. And so the thing that's kind of funny about this whole thing is like, to your point about, junk fees and all these things, like those are very populist policies and messages and rules in a lot of ways. And again, I'm not arguing them on their merits so much as saying that like, strangely, it's like, you have the circle that actually ultimately connects and the snake eats its own tail. Like the CFPB and its sort of populist instincts are not totally incompatible with a part of sort of the Trump administration. And so I think you're right about the temptation to use, now they'll rebrand it and they'll call it something different. Like we're not doing that, we're doing this, but it'll still have, I think in a lot of cases, that sort of populist flavor to it. I do think the only group I'm looking at that I think benefits potentially from significantly weaker consumer protections over the next couple of years is the crypto industry. And Brian Armstrong weighed in on Twitter, the CEO of Coinbase, saying that like, yes, we should delete the CFPB. And he actually got fact checked by Twitter, which was kind of funny. But that I think speaks to this idea that there are certain entities within financial services that sort of live in like these boom and bust cycles where it's like, when it's boom time, we need to make as much money as humanly possible, damn all the rules. And then when it's bust time, everything will go away and we just have to kind of hibernate and survive. And I think the crypto industry, we'll see what comes more on the commodities and securities and all that kind of rulemaking. But on the consumer protection side, I don't get the sense they would love a resurgent CFPB. So that'll be interesting to watch. But speaking of the permanent director who's been nominated but not yet confirmed, I actually have never gotten a chance to speak with Jonathan McKernan, but from what I've heard from others, he's a pretty serious, well-respected regulator who seems fairly pragmatic. Obviously, he served on the FDIC board, and seemed to get along fairly well and be fairly collaborative, even with his sort of democratic sort of colleagues on the board. Do you have any sense of like how he would approach running the CFPB, or how things might be different or how things might be the same?
I think what you've heard is right. I think he is a very pragmatic, well-respected regulator. He's what we would think of as a traditional kind of Republican appointee to the agency. He's certainly qualified for the job. I'm sure he's said and done some things that the Democrats will object to. So again, this is all pretty standard fare. You would see the same on the other side if the positions were reversed. But he's a solid choice. In other words, like a very credible choice, makes a lot of sense, very thoughtful, very smart, is going to approach the CFPB job probably knowing and understanding the factions that I'm talking about within Trump land and appropriately doing it. So, it's tough for me to get a sense of what his priorities are, because at the FDIC, his priorities were, he was worried about bank control. He made one thing, he was probably a thorn in the side of former FDIC chair Marty Gruenberg, because one of the things he liked to do was they would have sort of these closed door, meetings. And then Director McKernan would put out these statements detailing what happened in those meetings, which is fairly unusual, but not unprecedented, and certainly within his right to do. And part of that was he felt like he seemed very intent on it. He felt like the current FDIC management was covering up for mistakes it was making in the whole workplace culture issues. And he did not want to be part of that cover up by saying it should all be part of the closed door meeting. So again, there was a logic behind what he was doing. It made some sense, and it made sense for him to do it. But just to say, I don't know that the Democrats on the board appreciated him doing that. But I think again, a thoughtful approach, a thoughtful regulator. My read right now is he will get confirmed. Again, will he get the support of Elizabeth Warren? Probably not. But it's certainly enough to get confirmed. And again, a very traditional, credible choice, if that makes sense. I'd be surprised if he's the guy to burn it down to the ground. It seems to me like you're going to bring him over to pursue agenda items you want him to pursue. That seems to be more his bailiwick.
Yeah, no, that sounds right to me. And yeah, who Elizabeth Warren would not object to is probably not a standard that we should be concerning ourselves with for the next 4 years anyway.
Yeah, exactly right. So she's ranking member in Senate banking, and she'll have her say, but I wouldn't say that would be persuasive.
Yeah, no, that sounds right. And I would tend to agree with you. And I will say, just as a capper on that point, that, sometimes these things end up looking different with sort of the benefit of some hindsight or some time. But yeah, I think certainly, and we're just about to get to the FDIC, that's where I want to go next. But objecting to some of the closed door discussions that were maybe creating some of the workplace culture issues that plagued Gruenberg's FDIC, that actually, I think in some ways seems kind of like a feather in your cap now. And so I think that they're like, again, I tend to fall more on the sort of pro-institution side of things generally, but like you can't look at the way that the FDIC has been operating over the last 4 years and not find some legitimate avenues for criticism. So no, I think that's a fair read. Let's jump to the FDIC because obviously, few things have happened. Gruenberg has stepped down as chairman of the FDIC, and Travis Hill, who was the vice chairman of the FDIC, has been appointed the acting chairman. Hill has given several public comments since becoming acting chairman. I believe you interviewed him, correct, Rob?
Yeah, I did at the Acquire or Be Acquired conference last month. Right.
So, so you've gotten a good sense of sort of what he's been talking about. It seems like from what I've seen, his comments have really focused on support for innovation, which is pretty consistent with what I think the general Republican agenda from a bank regulatory perspective would be. Closer collaboration with industry stakeholders, changes to certain proposed or final rules that came about under Gruenberg. I think broker deposits is probably the one that we all sort of knew was dead on arrival as soon as Trump had won the election. So probably some changes to some of the rulemaking that's been done, and then a desire to investigate concerns about debanking that have risen up again, kind of post-election as we've been going through this transition. The way I've looked at this, and I'm very, very curious to get your perspective, again, because you've interviewed him, you have a much closer view than I do. My perspective is that he seems to be trying hard to kind of thread a needle between addressing concerns about the FDIC that have bubbled up. And again, those concerns come from many different angles. There's the workplace culture, workplace harassment stuff that we were just talking about. There's obviously this whole other strain that's kind of burbled up from the crypto VC community around debanking and, reputation risk and some of those areas. while also not departing too far from mainstream views on bank regulation, which it seems from my perspective and my reading of some of his comments and speeches that he's given before, he generally seems to share. I mean, he seems kind of similar to how you were describing McKernan, in that he's cut from a kind of a traditional Republican bank regulator cloth in that respect. So what's been your perspective on him and then on his comments as he's been acting chairman?
Well, he's another he's an interesting choice for sure. And I think he's done a very good job out of the gate of trying to establish what he's about, right? He's acting FDIC chair, but he's essentially not, he's not doing a, placeholder or chair warmer or whatever you want to call it. He's charted forth an ambitious agenda. He is not waiting for someone to nominate him or not nominate him for the full job. And as you say, he's pursuing a lot of policy priorities that definitely the Republicans want. There's the issue over debanking. You and I have talked about this in the past of whether or not the FDIC and how active it was and how basically where it was coming from was the FDIC telling banks not to bank crypto. There are some letters out there from, that seem like there was an effort afoot by at some point. And it sort of depends on who you talk to. I had former Senator Patrick Toomey on the show not that long ago, and he was saying, listen, this was a Biden administration. They were pushing this. Anyway, my point in bringing it up is this is something that Travis Hill has said he wants to root out, get to the bottom of it. If it's happening, I want to stop it. And we want to be very clear that it shouldn't be happening again. So that's one of his priorities. He's also talked about trying to do regulatory tailoring. After SVB failed, the Democrats' line of attack was to say that regulatory tailoring went too far and they basically weren't applying standards to banks in this sort of medium-sized range. I don't know that I'd consider a $100 or $200 billion asset bank to be medium, but somebody does. And they were making the argument that, look, tailoring was a mistake. You should have been holding these guys to a higher standard. And it kind of got a bad rap. And it was sort of being blamed for that. One of the things that you've watched all the people in power now, we can talk about acting comptroller Rodney Hood, who was speaking earlier today at an ABA conference, is doing as well, is they are trying to bring tailoring back. And so that's one big thing that Travis Hill is talking about, is saying, listen, I don't want small banks to be subject to the same stringent rules as bigger banks. The other thing he's talking about is what can we do about de novo formation? We've just watched this consolidation happen. I mean, the number of banks, I think when I started out in the industry, there were 20,000 banks. I don't know.
I wanted to ask you about that. We should go back and look at the chart and figure out, because was it 2000 when you started at American Banker? Is that right?
It was. I started in May of 2000. There were a lot more banks.
Yeah.
And you've just watched that number fall apart. Now, part of the reason it created so hard is the 2008 financial crisis. And then after Dodd-Frank, the pace of consolidation really increased. And some people will blame Dodd-Frank for that, not without reason. And so the idea has been, though, are we watching community banks go away? I hope the answer to that is no. It's one of those things that I feel really personally passionate about, is community banks are great. And so I think Travis Hill would agree with that. And he's trying to find a way to make sure that the artificial constraints on consolidation go away. That is, you can't have the past like you've had of the Democratic regulators under the Biden administration, who've been trying to give a red light when it comes to M&A at any level, but particularly at the biggest banks. At the same time, though, he wants to find ways to bring about de novo formation. You just don't have. Back when I started, there were a lot more banks, but there were hundreds of banks being formed, over periods of a couple, 2 or 3 years. Now you just don't see that. You're lucky if you see one a quarter. So you've really seen that turn. So that's something else that Travis Hill has talked about, is how what can we be doing to bring back de novo formation? So he's talking about a lot of things that are, you said earlier, he's trying to thread a needle. So on the one hand, he's doing the things that the administration wants. There are, I think, 500 FDIC employees that are taking the buyout offer that DOJ was offering. So that is, we're cutting, I think the agency is about 8% by about, so it's, and there's talk somewhere of having the OCC run exams for the FDIC. And I'll be honest, I'm not sure that will legally swim. So we'll see about that. And I don't think, Travis Hill will do what the administration wants him to do. But my guess is his focus on cutting the things that he can easily cut, refocusing so that there's a little bit more attention paid to tailoring and bringing that back. And then, as you said, getting rid of the proposals. Broker deposit proposal that was put forth by Greenberg is dead. There was a corporate governance proposal that someone in the industry I know, as a friend of mine, described it as the most Marty Greenberg proposal they'd ever seen. They just felt like it was too complex, and that's dead. So, a lot of this is sort of Travis Hill pursuing things that I think a normal Republican administration would be, a regular standard administration would be pursuing, combined with also trying to accommodate the Doge people who want to make the government more efficient. And so the probationary employees at the FDIC looks like they will also be let go. Long term, I don't know what that means. You do need some examiners into the system, but I think there is a thinking on that side of the fence that, listen, maybe you had too many examiners and they were all looking at the trees and not enough at the forest. That's a position that Greg Baer was taking at BPI just a couple of weeks ago. He was making that argument. You had like 42 examiners at SVB, and did that help you?
Yeah,
it did not. And you might have been better with 3. And the argument there being, it's somewhat counterintuitive, but the idea that someone might have been looking at the holistic risk, and instead you had everybody looking at different parts of the risk. And it was like, the old saw about being in a room with an elephant. Everyone in the dark with an elephant was, reaching their hands out and describing different parts of the elephant, and no one was realizing it was an elephant. One person thinks it's a pillar, the other person's feeling the trunk. I have managed to mangle that metaphor, and I'm sorry about that. You get where I'm going with it.
Yeah, no. I mean, it's exactly right, and I think it's a point fairly made about tailoring regulation, right? Which is like, how did this SVB thing happen? And to your point, I don't really buy the argument that it's like, oh my gosh, if we just had 20 more examiners in there who were looking at different parts of it, like clearly there was enough data to know what was going on. It's the process and the way that they were approaching regulating and examining SVB that sort of missed the forest for the trees. And it's funny, I'm so sympathetic to the sort of philosophical argument behind a lot of this stuff. My objection tends to be more in the practical of like how it's done, but like this idea that how many supervisors do we need, and how tailored should regulations be? Well, I actually tend to think that we should have a very supervised approach to regulation, and we should try to have a very efficient supervisory structure that's data-driven and that puts human beings in a place to actually see the risks holistically and not just have them combing through lots of documents where their time is being sort of wasted. So this idea of modernizing our approach to supervision, making it more technology-driven, making it more data-driven, making it more efficient, all of that I totally buy. The same thing with supervision applies. Like, let's have tailored supervision. But, Rob, I'll give you an example of, I think, the difference between my definition of tailored supervision and the vision that I sort of worry about that I sometimes hear on the banking side of it, which is I don't ever want tailored supervision to mean just looser supervision or just less supervision. And a really good example of this that I think will come up for Travis Hill and for the FDIC is banking as a service, right? Because most of the banks that do banking as a service are small banks. There are a variety of reasons for that, but they tend to be smaller banks. A lot of them are primarily regulated by the FDIC. And I'm not saying that they should be put through the same exam process that JP Morgan Chase has put through. That would make no sense. But I also don't think they should go through the same exam process and same supervisory process that a small community bank that doesn't do any fintech partnerships or banking as a service should go through. Like, there is a novel set of challenges to operating in banking as a service, which we've seen how that goes when it doesn't work. And so I'll be very curious to see with the FDIC and with this focus on tailoring and on sort of efficiency and a more sort of sculpted way of doing this. There's a very good version of that I'm all for. And then there's a version of it that's more just like, this is code for less work for banks and more sort of freedom to do what they want. And I don't know that that's always a bad answer, but at least in certain cases like banking as a service, I have some concerns about that.
You're hitting on a really good point, particularly when it comes to, because it's very tempting for tailoring to be like, well, if you're below X asset amount, you should, face much fewer examiners and everything else. And I am very sympathetic to that. But what happens when you have a small bank that's working for FTX, which definitely is a thing that happened. FTX went out and bought a very, very small bank and had it doing what I think most of us would regard as fairly dodgy activities. And so So you can't completely then say, oh, you're below this asset size, you're off the hook. And so this is what you always get into when you're talking about, like, on the one hand, you do want to create space for traditional community banks that are relationship driven funding, customer service oriented, to face fewer restrictions, because, I'm more confident that they're not the ones out there they're not trying to screw over their customers. Their customers are in their damn neighborhoods. You know what I mean? That's the goal. They're not trying to screw over their neighbors. And so to the extent that they're running afoul of something, it's almost always going to be unintentional. And you want those people to face fewer red tape so that they can thrive and so that there can be more of them. At the same time, you can't then pick an asset size and say below that asset size, because then someone takes advantage of it, and you're creating a loophole that someone can go through. So you want to be watching out for, I guess, banks that are growing really fast, which would be something that would be, could be a potentially red flag if they're just suddenly through the roof. What are they doing? How are they doing that? So that's kind of the dynamic you're getting at. There are ways to look at this that go beyond just asset size. A straight asset size is going to allow some players to do some bad things, but you could start making asset size as your first test, but then start looking for other activities that raise red flags that would make an examiner sit up and go, okay, you're doubling your asset size in X amount of time, and that's very unusual. Or your uninsured level, let's just take SVB, right? Uninsured, they were running our uninsured at 93.7%. I mean, that's insane.
It's crazy.
And the examiners knew about it, and nobody said, hey, that sounds really high. And what happens if somebody starts running, which is exactly what happened? It was a red flag. So there are other ways to do this other than asset size that can break it down. But I agree with you. I don't think we want tailoring to become code for, everybody gets a looser hand, because once you have that, you can run into a world where then we get a financial crisis again, and we don't want that. You know what I mean?
Right.
Like that's not good for anybody. It's certainly not good for the banks.
No, it's exactly right. And I think that, the other, I guess, sort of language that's been used to kind of describe this shift is this idea of regulating the activity rather than regulating the institution. And I like that as sort of a mental model in this way as well, because again, to your point, if you're doing sort of traditional community bank things, that should equal a very different sort of level of scrutiny and supervision. If you're doing novel fintech, crypto partner things, that should just be a different level of scrutiny. And not that it's not tailored to that, and not that we're trying to kill that activity in any way. Correct. But we just recognize that the risks of that are fundamentally different. I do think Hill, and he's not the only one who's been talking about this, I am really glad to see the focus on de novo formation come back. I've always found the discussion around the consolidation of banking solely being a function of the pace at which people are buying each other, but not the pace of new baby banks being born, as a very strange way of thinking about that from a policy perspective. Like, can we, somehow artificially extend the lifespan of this bank that wants to sell and someone else wants to buy it so we can maintain the size of the financial institution as it currently sits? No, probably not. And I don't think we necessarily should. That if it's a good outcome that everyone's happy with, we should let that happen. The challenge is no one wants to start a new bank anymore. And so I will have to probably have you come back, Rob, for a deeper dive into the world of de novos, because I have lots of questions there. But in the interest of time, I want to jump to the OCC.
Before we do that, can I have a brief rant?
Oh, I would love it if you have a rant. You've listened to Bank Nerd Corner. Kia and I love ranting about this stuff. So go, rant.
So, and I love Kia too. She's good for ranters. So one of the things that actually passionately drives me insane up a wall is I watch CNBC, and I shouldn't. It's not good for my blood pressure. And whenever there's a banking crisis, inevitably some idiot will say, and multiple idiots will get on there and be like, we have too many banks in this country. And it's absolutely not the problem. It's like, not the problem. You're not diagnosing the problem in any way, and your solution sucks. Because your solution is usually to get down to like 100 banks, as if there's a manageable level of banks that like everything will be perfect at. And meanwhile, you're making us more like Europe or more like Canada, and those places are fine. I'm not trying to bust on them, but one of the things that does make America great is the fact that you can find a local bank in your community and use them, and they know you and they're part of you. And I'm sorry to sound like I'm advertising for the ICBA. I don't mean to be, but I just believe like this is it it's kind of an ingrained thing. I don't want just a handful of banks in the country. I don't want just 100 banks in the country. I am not going to find the bank that best suits my needs. And there are a lot of communities out there that are not going to get served. And so it's like travel across the damn country. There are a lot of areas. I want more community banks. I don't want fewer. And I don't think a solution to anything is when some idiot's on the TV being like, there are too many banks in this country, as if they just can't grasp 4,500 banks. And that's not the problem, and your solution sucks.
Well, all right. So you just triggered me to want to rant about it for a second. So just allow me to respond. That I think is exactly right. Actually, it's interesting. Michael Hsu gave a really interesting speech about this a year ago, maybe a little bit more than that, talking about what's the right number of banks in the US. And he pointed out the exact same thing you pointed out, which is, look, the US is weird, right? It's big, it's economically diverse, it's economically dynamic. It's a massive geographical space filled with all these small communities. And, I live in Montana. I can tell you that there are banks and credit unions in small towns in rural Montana that know how to do types of lending and types of banking that cannot be replaced by JP Morgan Chase. They cannot be replaced by a fintech company. They are unique to the communities that they serve. And, to your point about Canada and Europe and other places, for folks who want to make that comparison, please pick up a book called Fragile by Design, which is something that Kia actually recommended to me. And it is a wonderful book tracing the history of how different banking markets have evolved over time and what the policy goals were in the early formation of those banking markets. And it explains in excruciating, and I'll be honest, very dry detail. So I apologize for giving you sort of a boring book recommendation, but it's really interesting because one of the kind of core points that comes out of it is, using Canada as an example, they only have 5, 6 banks. Those banks and their banking system are incredibly stable, right? They never have financial crisis. So that's the trade-off. That's the thing they get for having a small, highly concentrated banking sector. The cost of having that is that their regulatory apparatus in Canada is utterly captured by the big banks. And so you want open banking in Canada, they're going to drag their feet and drag their feet and drag their feet, and you're never really going to get it. You want a flourishing fintech ecosystem in Canada, and I've gotten in trouble with my Canadian friends who work in fintech north of the border saying this before. Canadian fintech hasn't gone anywhere in 20 years, and it's because the market is specifically designed to be small, highly concentrated, and very stable at the cost of all of these other things. So, long way of saying, Rob, I could not agree with you more, and I appreciate you inserting this rant into our discussion.
I just feel like making that rant as much as humanly possible. Again, this is why I should not watch CNBC, particularly during a crisis. My dad used to shout when he watched the Atlanta Braves play. My dad, very calm individual normally, but he would normally watch the Atlanta Braves do that. This is my equivalent of whenever I watch CNBC, and it would be there are too many damn banks in the country. It's like, guys, that's not the problem.
I think it'd be really fun to get Kia, maybe our friend Jason Mikula, a few different people together for a live podcast recording / watch party of some financial crisis that's happening, and we just turn on CNBC and watch you lose your mind. So I think that actually would be a fun live show we could do.
It would be a good time because I guarantee it would be within 5 or 10 minutes that somebody would say that. There's just always somebody who wants to make that point. It's just they can't conceive of more than 100 banks in the country. It's just so weird.
And everything, and this is just the thing with all policy stuff, right? When I was in DC, actually, someone made this point to me, and it's a really good way of just framing this generally. There are no things you get for free. Everything is a trade-off, right? So all the things we do, and the reason we do certain things and not other things, it's because we made trade-offs. Now, should we revisit those trade-offs? Should we challenge some of the assumptions or constraints that initially went into those trade-offs because they might have changed? Absolutely. But don't fool yourself into thinking we can have everything that we have now and none of the problems if we change this thing, because everything is trade-offs.
Right. I don't want to live in a world where there's 5 banks or 6 banks or 8 banks or 100 banks.
No. I've worked too closely with the big banks over many years to want that fate for myself. I will be honest.
I'm not even trying to bust on them, right?
No, I hear you. It's just there's a benefit.
what makes things interesting and what unique is, I want to see the Citizens Bank of Edmond and Oklahoma out there trying to do what it wants to do.
Shout
and how
out to Jill.
people.
Yeah,
there
absolutely.
you go.
Absolutely.
And deep cut, I want to see the Vera Banks of the world in Texas out there doing interesting things. I think this is the way to think about it, as opposed to I want to homogenize the system to some magical level of banks that you say will be better.
Yeah, no, I totally agree. And it sounds like Travis Hill does too. So that is good news. All right. So let's jump real quickly before I let you go to the OCC. Less drama, as far as I can tell so far. I mean, who knows?
Yeah, they don't seem to want to cut there deeply. I haven't heard any talk about that.
I haven't either. Maybe it's further down on Doja's list.
It's a smaller agency. It doesn't.
Smaller agency. It's kind of folded in. Yeah, I maybe they will sort of skate by on that front. But they do have a new, I guess, acting comptroller. So Rodney Hood has been appointed to lead the OCC, replacing Michael Sue, who we were just mentioning. Rob, this is one of those ones where I just am kind of a blank on Rodney Hood because he has not been sort of in a regulatory seat recently, although I know he worked at the OCC before. Can you give us just a little download on him and kind of what you think this means for the OCC?
So he was a former chairman of the credit union regulator, the National Credit Union Administration.
See, there they go. They make an appearance.
So he is, they do. So that's what he's known for. Now, he spoke earlier today, I don't know by the time this runs, but he spoke at an ABA conference recently, and he talked about how, listen, I'm not a credit union guy, I'm a safety and soundness guy. And before I was at the credit union regulator, I was a banker. And he was very pro-community banking. He's now, we should talk about, there is someone that's been nominated for the full-time job. So I do not know, and he does not know, I'm sure, how long Rodney Hood will act as acting comptroller. And that is a difference from the Biden administration. We had Michael Sue as acting comptroller for 3+ years. And they tried to nominate someone, that nomination went down. And then we had an acting comptroller for the longest period we've ever had in American history. Yeah. So and there was some thinking that maybe we would only have acting comptrollers from here on out. That does not appear to be the case. We've chosen Jonathan Gould. He's a partner at Jones Day. He's a former general counsel at the OCC. And he is also extremely credible choice, very smart, knows his way around the OCC. I think one of the interesting things here is if you leave Travis Hill in as acting chair of the FDIC. He used to work at the FDIC before he was vice chairman. He was deputy to Yelena McWilliams when she was chair. He's got 6 years of experience at the FDIC. So that is somebody who, from your Doge perspective, can implement the things that you want to implement because he knows his way around the agency. He's not new to it. Same thing at the OCC. By picking someone like Jonathan Gould, this is somebody who knows the OCC well. So that makes some sense. Jonathan McKiernan has some exposure to it from being on the FDIC board. All this, it sort of gives you a sense that there's, I guess, an idea out in the world that the Trump people are picking wild choices. Well, not in the regulatory sphere. They're picking very, again, credible, rational choices. It's the same thing with Rodney Hood. I mean, he's definitely a credible, rational regulator. He is saying that he is already coming in with ideas. He does not want to be a seat warmer. And he doesn't know how long he has. Probably, assuming everything with Jonathan Gould goes correctly, he has till mid-May. That'd just be a guess. I don't know. It could be maybe a little shorter, maybe a little longer. And he said he wants to visit all 50 states. He wants to look at regulatory tailoring. He's big about talking about check fraud. That's something that we've watched. It's just weird that number of checks being in use has declined, but check fraud's a real problem. And it's a growing problem, and banks have some issues with it. So he's telling them things he wants to hear. And so the one message I think he was trying to get across is there were some in the industry, banking industry, who were a little skeptical of him because he was a credit union guy. And keep in mind, they really do not like credit unions buying banks.
Yeah, banks and credit unions at kind of a level that maybe listeners to this show don't appreciate. If you want to make a community banker lose their mind, just mention credit unions' tax exempt status, and they'll flip out and rant at you for hours on end. So there's a thing there.
There is a thing, and so I think he's trying to draw that distinction and say, listen. I am just here to do the job. One thing that's very interesting is, it's not that unusual for a Republican leader. You saw a little bit from Joseph Otting, who was the last comptroller in the first Trump administration, but he was saying, I want to work with you. That's usually very different. Democratic regulators do not come into the job and say,
they don't say that. Yeah.
They don't know, they don't announce to a conference room of bankers. They just say, we're here to keep you safe, but yes, we'll look at things. He was a little bit more open, like, come in, tell me what regulations are bothering you. I want to make sure they make sense. And that is, I guess, I think a little bit more consistent with the credit union regulator. That's usually why community banks are so mad at them. They feel like the credit union regulator is trying to help the industry a little bit too much, and they feel that of Democrats and Republicans. And I guess it's that kind of spirit that he's bringing in and saying, listen, I want to work with you. I want to reduce regulations. And I think the literal quote was, Wall Street's been having it good for a long time. Now is the time of community banks. So he's trying to signal something very clearly to them. Look, I'm going to be a different kind of comptroller. You let me know where you see problems. A lot of what he's identifying already, I think he's only been in the job, a week, but he's trying to move quickly forward while this other nominee takes place, because he has no idea how long that's going to take. And as we saw in the Biden administration, sometimes things get held up. I'd be very surprised if that happened with Jonathan Gould. Again, pretty stellar choice. It makes a lot of sense. So I'd be surprised if he got hung up in the nomination process, but you never know.
Yeah. Okay. Interesting. All right. So that covers off on the OCC. And now let us end with, real quickly, the Federal Reserve. Very interesting on a number of different levels. Real quick summary. Jay Powell has said he's not leaving and will resist any attempt to make him leave. Michael Barr, who is the current vice chairman for supervision on the Federal Reserve Board, has said that he is stepping down from that role, not from the board, but from that role at the end of this month.
Which is an important distinction, by the way, because you still got a board.
Yeah, he's still hanging on to his seat.
Anyone for the board. He can pick someone on the board now to be vice chairman of banking supervision, but he cannot pick someone brand new because there is no board vacancy.
Yes, exactly. So limits his pool of choices.
It does.
It also is interesting because, as you referenced before, Powell was just at a House Financial Services Committee hearing and was actually asked about the vice chairman for supervision role, which I did not realize was actually created through Dodd-Frank in 2010. So not a long-standing position for the board. And he actually said that his opinion, at least, was that the Fed operated without one for many years, obviously, and believed that the board was effective and that there was maybe less volatility associated with that before that role was designated. So kind of some interesting comments there from Powell. As you referenced, for this particular vice chairman for supervision, Trump has to sort of select from the governors who are already on the board. Everything I've heard is that Mickey Bowman is kind of the obvious choice, but do you have any sense of assuming that they don't get rid of this vice chairman for supervision role, which would be something that Congress would have to do, which I would not anticipate. What do you think about Powell's comments? And do you think it's Bowman or do you think it's someone else who replaces Barr?
So let me answer the latter question first because it's the easier one. Yeah, I think it's Bowman. I think it's Fed Governor Bowman because, first of all, she just makes a ton of sense. She's already sitting on the board. If you've listened to her speeches all during the Biden years, she was initially appointed by President Trump as a Fed governor, but she's given very, again, thoughtful responses.
Super thoughtful.
She's smart. Not at all. These aren't knee-jerk responses where someone's like, "I oppose this because Democrats, support it." There's none of that.
Some of her speeches are some of my absolute favorites for just learning about banking. She's a very, very thoughtful person.
Exactly, and she's a former community banker. She's also a former regulator of banks at the state level. Yeah. So she is a pretty, really good choice. No, if you had, outside of whatever constraints you were facing on the board, she would be someone you would be thinking very seriously about. I watched Senate Banking Committee Chair Tim Scott recently at a public event. Like, that was the name that came to mind. Now, the fact is you don't have a board vacancy, so you have to choose someone anyway. There are really only two choices on the board you could make, and she makes by far the more compelling case because I'm not even sure Governor Waller even wants the gig. So it just makes a lot of sense to pick her. I'm just trying to say it's not just that they're picking her because their options are limited.
No, she'd be a great choice just
right.
with a full
They
field.
could wait until January if they really wanted to, and then pick whoever they wanted, because January, I think it's Governor Kugler will, rotate off the board. So that's the first Trump administration opportunity to pick whoever they want. But remember, they're going to be trying to pick a future chairman at that point.
Right.
They're not, that's the idea they have to keep in mind, because theoretically, Jay Powell could leave the chairman role but stay on the board, which would constrain them from picking anyone they want. So, again, it makes a lot of sense for many different reasons to pick Governor Bowman. And my sense is somebody's only dotting I's and crossing T's or whatever in Trump administration land. I've actually heard that Trump land likes her a lot, including multiple factions of Trump land. So it's you've watched a sort of dynamic play out at the FDIC and the OCC and the CFPB and who's getting what jobs. This has been very consistent. I was hearing a bunch of names for those jobs all the time. They were rotating who's up, who's down. This has been like Mickey Bowman. So, if it's not Mickey Bowman, I will be shocked. I also won't understand it.
Yeah, right. So then what did you think of Powell's comments about the role itself?
Probably reflecting some degree of frustration with Michael Barr. So there have only been two people who have formally held that job, Randall Quarles and Michael Barr. Dan Tarullo was a former Fed governor who effectively filled that role, but he was never nominated for it. There was always a Fed governor who took the lead on bank regulatory supervision. But the thing is, the Dodd-Frank law gave that power, gave an enormous amount of power to that vice chair, whoever was sitting in that seat. And I think it was Randall. I had former Fed Governor Quarles on the show a couple times, and he talked about how it was possible to interpret it so that that vice chair didn't really have to seek out any kind of consensus on the board. And he said, I didn't choose to do that. Even if I knew that my Democratic colleagues weren't going to vote for something, I at least shared it with them. There's the feeling like that didn't happen under Michael Barr. And even some Democratic Fed governors felt frustrated with, say, the Basel III proposal, the way it initially came out. It was fairly obvious that Jay Powell felt frustration, that it came out with a proposal, that the data wasn't necessarily there to back it up, so that when the banks went after it, and it was pretty obvious from the get-go they were going to, they didn't have as good a substantive standing as they might have otherwise done if he had shopped it among even the Republicans and maybe taken some of their feedback, even if he knew they weren't going to vote for it. So there was a feeling like he went off into his corner and created it. And then they got burned, and they got burnt badly, and the Fed lost institutional power. So I think, just as I'm interpreting psychologically, I think what you're watching is Jay Powell express some of that frustration out loud. Like, things worked better when you didn't have a concentration of power in this one particular role, and then it was left up to that person to decide how much information am I sharing with the rest of the board. That's my interpretation of what he said.
Got it. That's super helpful context, because I figured there was something behind the word choices he was making, but I wasn't sure exactly what it is. So that makes sense. All right, Rob, last question, then I'm going to let you go. In his testimony, Powell also was asked about debanking, our favorite topic, and specifically I thought, and this was a very good question, actually, was asked about the use of reputation risk as a supervisory tool that can be misused. And interestingly, he committed to revising the Fed's supervision manuals to remove reputational risk as a tool to weigh in on political topics, which is a question that relates both to the Fed's supervision of banks, but it also relates to the Fed's decisions on who to grant master accounts to get access to our payments infrastructure. Both of those are places where we've seen reputation risk used as a sort of weighty and somewhat mysterious lever to make decisions. So I wanted, maybe, Rob, as we wrap up on everything, given that everything we talk about now ultimately has to come back to debanking anyway, I wanted to get your sense of, just, were you surprised by that commitment? Did you think that was interesting? And then kind of more broadly, how do you see regulators, not just Powell and the Fed, but sort of across the board, responding to this whole sort of debanking debate? And what do you think might come out of it long term?
I was a bit surprised by the tenor of it, because he was pretty unambiguous while also not completely ceding ground. He was basically saying, look, there's so much smoke here, there must be some fire. So previously, when I've been asked about this, I've been sort of like, we're not doing this on purpose, but I'm hearing so many complaints and so many different kinds of complaints from people that there must be something behind it. And so when I had Senator Toomey on the show, he was saying, it wasn't just that banks weren't doing crypto securities assets or custody. What they were doing is like denying bank accounts to people who just happen to work at a crypto company. And he's like, and that's debanking from his point of view. Mm-hmm. And so I do think it's interesting that Powell is coming out and saying there must be some form of it. I mean, some of it's political in that the winds of power have shifted. Yeah. And he runs a real risk, if he sits there and says, no, it's not happening. And I don't see any evidence of it. Mm-hmm. And that could, he said that he's not been a target of Doge. I believe him. And because my guess is Doge doesn't want to mess around with the Fed. Things can get very broken very fast if you do too much of that. So I think he wants to keep things that way. So by saying, there's a lot of smoke here, I'm going to go see if there's fire. I'm going to make sure that we're not doing things like encouraging banks not to, just bank someone who works at a crypto company. That doesn't mean they have to be doing crypto as a banking institution. Yeah. Just not stopping these guys from having checking accounts would be a start. So I find it surprising the length he went to. Ultimately, I guess I shouldn't have been surprised by the strategy of it all. It makes some sense. Where does it end up? I don't know. I think, they will be looking for proof that the Biden administration top regulatory sphere said, don't do this. And I think, to the degree the agencies are run by new agency heads, they will be in there looking for that. And if there is proof like that, I think you're going to see more of it come to life. You already saw the FDIC releasing all those letters publicly. I mean, clearly Travis Hill is trying to say, this wasn't my bag while I was vice chairman, and I'm trying to be as transparent as possible. I think he's done a good job at that. So that's what you're going to see more of. To the degree that there is no smoking gun, or whether you debate whether there already is one, I think what you're just going to see is the agencies looking at creating a way that this doesn't happen again. Like, I don't think anybody thinks it's going to happen now. Certainly, that these set of regulators, but they're going to be looking at what are the rules that we put in place. Is that a law like what Andy Barr suggested on the House Financial Services Committee? Mm-hmm. That's something that banks are a little uncomfortable with, but some of them have a leaning to because they don't want to see a bunch of state laws. Florida has been flirting with a law to basically say who you can and can't have relationships with. So all this gets a little dicey because you don't want to set up a system where you say a bank has to have a relationship with X kind of industry. Right. At the same time, reputational risk is this gray area that Powell is signaling, look, maybe we put too much emphasis on reputational risk and we ought to dial that back.
Mm-hmm. That sounds right to me. I mean, the thing that's always struck me about this is, to your point, you described it beautifully. It's this continuum, right? And so like the continuum is, hey, on one end, you're not allowed to bank these particular individuals or companies. On the other, the continuum is kind of what you're describing in Florida, which is you must bank these individuals and companies. And I think where banks, for whatever degree they are weighing in on this whole debanking thing, what they want and what they've always wanted is give us the discretion to decide who we want to work with and who we don't want to work with. And I think that, reputation risk, from my vantage point, was one of those things that was used to sort of have regulators weighing in on who they thought banks should be working with, because reputation risk is just such a hard sort of nebulous thing to like quantify or to try to understand. And so it always sort of struck me as something that was a little too far outside of kind of the traditional definition of safety and soundness to really be something that weighed on banks' decision making. But at the end of the day, they kind of respond to whatever their incentives are. So I think your read of it, that sounds about right to me.
Yeah, it's an interesting dynamic. We'll watch it continue to play out, but you're just going to see these set of regulators putting a lot less emphasis on what is a reputational risk, and what does that really mean. And this idea of you can go too far in saying banks have to do X. So Greg Baer was bringing up a purposely absurd, example of what happens if somebody slaps your teller. Do you have to bank them?
Right.
I don't know. I mean, like. It gets interesting, right? That's not a reputational risk issue, presumably, but like you can't create a rule that says you have to get a bank account somewhere. Again, what if someone is just you view as a safety threat to your employees. I don't know. But all this gets a little dicey when you start talking about a legislative fix or regulatory fix, and there have to be some kind of broad guidelines that also allow some discretion.
Yeah, well, and I think part of the discretion that goes into it is also allowing banks to fail, right? Too. I mean, like, I think part of what I've sort of come away from the last couple of years around is that, to a degree, banks take risks, and sometimes the risks don't work out, and there's a whole set of sort of cascading policy choices you have to make around that. But to a degree, the freedom to bank or not bank people also goes with the freedom to make a lot of money or to go out of business. So I think there is a certain amount of that volatility that's just kind of baked into a healthy banking system. Rob, this has been amazing. I could keep you on for another hour, but you have an actual job to do, so I will let you get back to it. This will not be the last time you come on Fintech Takes. I really appreciate you coming on this time, though. Could not have had this discussion without you. I really appreciate it.
My absolute pleasure. Like I said, longtime listener, first-time caller. Pleased to be here, and anytime you want me. Thank you so much, Alex.
Thanks, Rob.
Thank you for listening to this episode of Fintech Takes. Stay up to date with emerging companies and the latest fintech trends by subscribing wherever you get your podcasts. And if you love Fintech Takes, please tell a friend.